Okay, everyone. I hope you're well today. My name is Chris Laurie. I first want to thank FXStreet for the privilege of having the opportunity to share some information with your membership. My name is Chris Laurie, and today we're just going to talk about the basics of building a price action trading model. Just to put things into context, my intraday model is based on sheerly on price action, price behaviors, and consistencies and specifics of price behavior. And so what I'm going to do is I want to share with you just sort of some of the foundation of how I developed my core trading models. And what I believe is very, very important is when you go through the exercise of building a trading model, regardless of what it is. Now, as a side note, I realize that those of you listening to this webinar, everyone has a different way of trading. Some of you may have mathematical models, your indicators and whatnot, maybe partially price action. But I'm going to really focus specifically on price action. Perhaps it will be able to contribute to how you currently trade, perhaps not, but hopefully you can find some value in the information. If you have some questions as we proceed, you're welcome to put them out there. But what I believe to be very important is, as going through the exercise of building a price action trading model, as you focus on an intensive element of the intraday price behavior, it really builds a very, very strong foundation, regardless of how you take positions in the market, be it a higher rate of frequency of trades throughout the day, or whether you become a swing trader or a position trader. So just a little bit back, I participated in 4 Olympic Winter Games in bobsledding. We were overall World Cup champions, 9 World 22 World Cups. But I have a sport history, is where my background is. I am university educated on top of that, but just a little bit of background on myself. So model building requires a specific plan of study with a goal of internalizing price behaviors and market function. So we always hear about how important it is to have a trading plan. It's actually even more important to have a development plan, how you plan on developing as a trader, because you need to have this plan in place before your trading plan, because where are you going to get your trading plan? If you're just trying to copy a trading plan from somebody else, it's simply not going to work for you. So you have to go through the process, develop a plan, so that you can internalize the price behavior that you're studying, and you'll get a real deep understanding of market function. And I want to walk you through this process. So it's really critically important that you build this development model, your development plan, because ideally you need to internalize the price behaviors. So these are just a couple slides I'm going to go through quickly. Your trading model has to develop in a slow process, which we're going to cover today. Your psychology is going to develop with the development of the model, and of course, risk is your ultimate governor of maintaining the two, developing at a consistent rate. Plan out specific parameters to test under various market conditions, and we're going to talk a little bit about that today. So this is sort of just a bit of a layout in terms of how your plan can sort of how your development as a trader should proceed. So what I call in this column here, I call the parameters, and every one of you have a different set of parameters. Some of you take the technical, some fundamental, some the psychology. You'll have, of course, various risk parameters. Some of you are inclined for algos or mathematical models. There are other very, very important elements to your trading software interface, the efficiency of your overall operation, your plan of study, the results of the study, and we all access various resources to complement our development as traders. And so what we're going to focus on today is just the technical element, and we'll be looking at, let's call it stage 2, because the majority of you have probably gone through a bit of a foundational stage where you've gone out and you've explored and have acquired a certain level of market information to get you to the point where you're at now. So So we'll just look at stage two. We're just going to focus on a technical element specifically, and let's call it price action, because price action is, of course, my model. And if we break price action down into various elements, there's obviously a whole continuum of elements that we can study. But let's just take a couple of examples. So the price behavior that occurs throughout specific times of day, obviously the volatility and the liquidity will change, whether there are events happening, central banks speak, when certain market hours are open, when they're closed, and other elements related to that. Now, the volatility would be categorized separately. So you have different levels of volatility depending on what type of data that is being released, depending on the profoundness of a level of expectation of a central bank speak. Anything centralized around monetary policy is going to drive different levels of volatility. And it's really, really important that if you're trading on an intraday basis, an intraday or even or swing basis, that you have a real strong sense of the level of volatility you can expect from the various price drivers. It's really, really important that you're connected with that. I talk a lot about fractal, which is just a term for patterns of price similarity repeated at every scale. So basically what we see is we see the element of psychology and liquidity and the function of liquidity played out in the market very, very similarly at all levels. So price behaviors we see on, for example, daily charts, we see the same price behaviors on 5-minute charts, except they're at a reduced scale. It's a different segment of the element of psychology and order flow, as we'll call it. So I just call this fractal, just patterns of self-similarity. We look a lot at simple support and resistance and the responsiveness of different currency crosses around levels of support and resistance, which we can have a look at today. And obviously news, we have a real good sense for, or it's good to acquire a sense for what type of impact news will drive under specific conditions, because obviously different news or data points will affect the market differently from one month to the next, depending upon what the nature of the market, is, what level of importance they're putting on different data points, be it real estate or CPI, manufacturing, etc. So we take each of these elements, call them components of the market, and we have to break them down into subcomponents, because ultimately where we're going with this is we're going to look at charts and we're going to determine how we actually structure this and apply it to sitting in front of our charts. Now, before we get into detail on this, I want to say that if you have a well-developed, a well-laid out development plan, rather than just sitting staring at your charts all day long, hoping that one thing or another will happen and hopefully a trade sets up, there are ways that you can really accelerate your development as a trader if you've got this good plan in place, because you can constantly be interacting with the market and internalizing the specific price behaviors. So if we take time of day, for example, you can break down time of day into things like London open, London closed, New York open, New York closed. The Asian range has a high level of responsiveness and impact throughout the course of the day. What happens at rollover auctions, things like that. So these are very, very specific areas where we're looking at what type of volatility these elements will generate. So now, once you get in, now each of these elements are effectively related in some way, obviously. So volatility, what currency pair, time of day, pre-news, post-news, and one of the things that we do is before the news, during the news, and of course after the news, we will interact with the market as to get a feel for different price behaviors and look for consistencies in the price behaviors to determine what value an identification of a consistency of price behavior will have in our trading. There might be There might be a trade formula there, or there may be just simply something that acts as a complementary element. Fractal. So we look at and study the price behaviors and look at the resemblance of the price behaviors on all time frames, because fractal ultimately determines our entry exit points, how we define our risk model. Support and resistance price relationships, order flow, we'll look at that a little bit today. Time of day and time frame, and the impact of liquidity pools, support resistance on different time frame. And of course, news, the importance of news, the volume, the volatility history. So for example, if every single month we study specific price behaviors at payrolls, for example, we look for certain consistencies and certain types of behaviors as it relates to as it relates to the liquidity provisions that, if you've seen my webinar on the function of the institutional environment and how the liquidity shifts, these are the type of things that we watch during news periods. So plan your protocol, which we're going to just cover some elements on that today. And we are going to look at some charts. You need to test it, validate it. But throughout this entire process, what the real value comes in the fact that you are internalizing the price behaviors. So that trading becomes you, it becomes a part of your persona. So if you're the type of person that is going out and you're exploring in the foreign exchange marketplace, and you're looking for somebody's trading model to copy specifically, and you want to do exactly what somebody else does and hope that it works for you, it's not going to happen, because you're trying to go from A to Z in one step. And it doesn't really work that way. You have to engage in the development process. And I'm just showing you how I did it, and you can adapt it to however it is that you wish in your own trading. And then, of course, integrate it into a real trading environment. As you put price action through the grind, you will internalize volatility as it relates to various drivers. Over large sample sizes, you can accurately build risk parameters to suit the trade setups in your evolving plan. So let's have a look now. What I'm going to do is I'm just going to give you some price interaction ideas. Then we can flip over to a chart, and we can flip over to a chart and have a look at how we would apply this. So what I refer to is price interactions. So a price interaction, of course, is let's say we have defined a character element of price behavior, and let's just say support resistance, for example. Let's just if you've got your platform in front of you and you want to execute, call it a trade. I call it an interaction because it's not really a trade. The idea of the interaction is to physically and emotionally engage into a trade entry. And let's say you put a 10 pip stop and a 10 pip limit, or it can be a 20 pip stop and a 20 pip limit. The idea is that you are engaging in the market under a specific set of parameters, be it support and resistance. And you are, by the fact that you are engaged, you're actually internalizing the price behavior, because you have a vested personal interest, and it can be a demo account and at some point live money. But the thing is that not all the exercises, they're not intended to be quote profitable. Okay? The idea is to engage in an interaction in the market, and if over a sample size of 100, 200, 500, 1,000, you may be receiving positive results, neutral results, or negative results. The point is that it is internalizing an emotion on some space in the continuum between positive and negative. So if I engage in 300 interactions and a large percentage of them are negative results based on a set of parameters, then that will negatively reinforce that price behavior in my persona I will negatively reinforce internalization of that price behavior. Therefore, when I observe that same price behavior in some event where I decide to take a live trade and I see this price behavior playing out, I need to reconsider whether or not this is a viable trade. This is very, very important. That's why when we engage in the process, we are neutral in terms of what type of outcome we are anticipating, be it positive, neutral, or negative. So a couple of interaction ideas is you can virtually create almost countless ideas to build a framework to interact with price. So let's just say, as an example, let's just say just executing at support and resistance levels. Well, then the question would be on daily charts, on 4 hour, 2 hour, 1 hour, what time frame? Well, that of course all has to be put in the framework as well. So let's say you have an interbank price run that we've discussed. Maybe you execute into the price run, or maybe you see a price run and you chase price. So for example, one exercise that I have people do is if you have an interbank price run, we trade into them. But as an exercise, you can actually trade. If you trade with the price run, watch what happens with the result of executing in the direction of a price run. Typically over time, based on whatever the parameters are, whatever the driver was, typically over time, you're likely to see that the result of that is quite negative. Depending if it's if it's closely connected to a central bank movement, the price run typically continues. But nonetheless, it is an exercise that you engage in to internalize price behavior. Let's just say figures. You execute every time maybe you hit a big figure or a 50 level or whatever figure is appropriate to that specific currency pair, because different currency pairs respond differently to different numbers. Momentum parameters. Maybe you are more inclined to trade with momentum. Then you want to engage in a process where that either becomes reinforced, positively reinforced, or potentially maybe there's something in there that's negative that you need to be aware of. And by going through the process of executing with momentum parameters, will help you to decide what balance you want to achieve with your execution. We do a lot of big stones interactions, which are basically executing into a price move. So that is a very, very important part, very important exercise in our protocol. Data point volatility entries. So for example, when a data point comes out, regardless of how impactful it is or how divergent it is from the expectation, when you're doing exercises, trade into the volatility, because it gives you a feel for liquidity, spreads, movement on different platforms, price jumps, price frequency of price jumps. All of these little idiosyncrasies then start to emerge and show themselves to you because you have something specific to focus on. If you're sitting at your trading desk and you're just really not that clear on things, then when you go through the exercise of really putting a good sample size together of each of these types of components, you'll see more and more and more and more, and then the market and price behavior will become very, very clear to you. Other specific technical parameters, there's really quite a range of them. And again, we all see the market differently, depending on where you're at in your development. But there are things like volume areas or price clusters, shifting points, a point of origin from a price run, which we covered in a previous webinar, breaking points, things like that. So these are just some price interaction ideas. I mean, we can really get very, very creative, and we do, because we want to virtually examine every corner of the market, every corner of price behavior, to discern what has validity, what does not have validity, what we're neutral about, because once we internalize that behavior, then it really guides our discernment through the entire trade process, from entry to trade management to risk management, and also very critical in defining our risk model. Okay, so let's just take support and resistance, for example, and we'll just flip it over to a Euro chart in just a moment. But some considerations that I would, that we would want to make is, what time frame support and resistance are we looking at? What type of response are we looking for? So we're going to test it. We're going to test a support resistance level. We're going to test like 10 pip stop, 10 pip limit, 20 and 20, 30 and 30. We want to test, obviously the wider we're going to go on the higher time frames, but what type of response can we anticipate off of certain, like what type of liquidity shifts and response can we anticipate off of different time levels? So what are the conditions that prices moved into support and resistance? Is it a data point where we need to stand out of the way? Or, is there a central bank tone to it? Or is it tightly connected? What I say is that is any data point that's tightly connected or focused on in relation to any potential move in monetary policy is going to be more impactful. So when central banks speak as well, very, very notable. So what about equities? Is it connect with equities or not? The time of day factors, is it efficient move, non-efficient move, numbers? What is the currency pair? Because obviously they all have different levels of volatility, and it can be different times of day, and there are a number of factors there. What are the response parameters that we're going to place around it? We want to internalize whatever type of price response we receive, and we need to remain very, very neutral. We can't have a bias. The idea is to really understand the price behavior. So how large a sample size? Literally should be in the hundreds and hundreds of sample sizes. So when you sit down at your computer, you should be busy the entire time. Okay? You don't want to sit around, have some parameters put in your chart and sit there waiting for hours and hours and hours and maybe days in the week, waiting for something to set up. You need to be learning, interacting with the market, and really taking that structured process to internalize very, very specific price behaviors. And not only will this exercise help to reinforce price behaviors that you may be somewhat aware of now, but you'll also begin to identify new price behaviors that can even be uniquely viewed on your own. So what behaviors are consistent and potentially tradable? So what I tell people is that when you go through this process, ultimately over time, you're going to find a price behavior that is highly, highly consistent. And what I say is that, look, just when you go through the process, find that one currency pair, and then all of a sudden a trade will emerge, a price behavior that you identify highly consistent. So that becomes your one currency pair, one trade. You start with that. In the meantime, you are still exploring, and not only is your exploration enhancing the high level of proficiency that you will have on the one currency pair, but it'll also begin to expand your trading profile and trade selection portfolio, not only to get a deeper understanding, but also expands your portfolio. So, okay, so let's just flip it over to, I need to pull up a chart here. So let's look at the, right now Yellen is speaking, so we can see price can get pretty jumpy, which is good. I mean, we want that, right? So let's just have a look at the earlier, we had some data out of the Eurozone earlier, which was modestly negative. Doesn't really matter, positive or negative, because one of the things you're going to learn is that whether the data event is positive or negative, it's not necessarily going to have a direct, specific, consistent impact on the direction of the currency. So, for example, just to give you some ideas, let's just lay out some simple support and resistance on this chart as we have here. So we had one, so pre-data, we had one here, okay, and here, just going back, looking at the order flow. This is a 30-minute chart, and we just drew out some basic levels. So when the data gets released, at the point of release, typically what happens is that when you've got uh, a notable data point that comes out, liquidity gets very, very thin. So you're going to see price will obviously, depending on what platform you're looking at, your prices are going to spread, because as you get closer to the event, liquidity draws away from the market, draws out of the market closer to the event. So if through the streaming order flow, all of a sudden you see a chunk that comes in, a larger size order, right around the time of release, it's going to have to find liquidity. So price will effectively spread, and it's got to run to find the liquidity to fill that chunk. And then it obviously, as I explained in my previous some of my previous webinars, is that it actually creates a trail of orders drawing up behind it like a vacuum, and it runs the price, and it typically overruns before it comes back into rebalance as liquidity draws back in. So in any event, we saw that price run come down, and we had a bit of a level support down here. But although this was the bid price quote, doesn't necessarily mean you can get in at that price, because liquidity is going to be thinner. You might get in at a much higher price, but doesn't really matter. The point is that when I refer to these exercises, what I'm talking about is, let's say prior to the event. This is a 30-minute chart, so we don't see a lot of details. But what you would do is you'd watch the price behavior unfold throughout the course of the event. And if you've just got a simple, so let's just say that support and resistance is our parameter. Okay, so we're going to execute at levels of support and resistance. Now, we're mindful that there's an impactful data point, but we're going to interact with the market at levels of support and resistance. Now, let me again state that the objective of the interaction is not to, quote unquote, be profitable. The objective is to interact with the market, have a set of parameters, maybe a 10 pip stop, 10 pip limit, or 15, 15, 20, 20. But you execute, and then you watch the price behavior intensely. Okay, you watch it with diligence, and therefore you're going to lay out the conditions of whatever the price driver was, or whatever the environment was at the time. You're going to watch price move in relation to the parameters that you have set forth, call it support and resistance, and then you're going to bring it to its conclusion, be it naturally or otherwise. So if I've got a 10 pip stop and a 10 pip limit, and sometimes I'll have 15 pip stop and 10 pip limit, because I trade based on a average gain loss ratio for intraday trading. So in any event, that it comes from this practice. So all I'm doing is I'm looking for evidence of consistent price behavior. So now obviously one interaction is just going to be a foundation. Sometimes, typically, you will have to engage for a period of time before things start to become more visible, before you start to get a grasp on some of these price behaviors. So now, as price proceeds, you might have an interaction here at 80 after the event. So we had a small price shift at 80, and we'll take it down to the 5-minute chart. So then you've got 3,800 big figure, where we see a price order flow here, and then it drops a bit, and we kind of consolidate some of the previous sessions. And so we have a price response here, and usually we start to slow off right around here. I'll show you what that looks like on a 5-minute chart. And so we make another run at 38, and now price is just stalled here. Now let's just take this down to the 5-minute chart, because you can get a lot of, while you can pull some levels off of the 30-minute chart, you want to have a look at what the price behavior is doing on a 5-minute chart. So let's just have a look. I want to show you some of what we're looking at. So price rallies like this. One thing, we like to see this inefficient move. The reason why is because there's a distortion in the liquidity, and usually we see price reference previous areas of order flow on the retracement. And so you can see here we went from 80 and then down to 65. So this is actually from 78 to 65. So 13 pips of movement here. And as you interact with price, you're going to really closely observe these movements. And when price is coming down, typically what I would look at is I'd look at just this level of resistance, and I'd watch the price behavior in relation to this level of resistance, just as you see here. For example, we have another price run, and it draws back into the higher part of the leg, right to about this resistance, a couple pips off, but 2 pips off, an 80 level. We had the 3,800 figure laid out in the 30-minute chart. So prices runs up to the figure, but watch what happens here. This is ultimately gets down to, this is really how we manage trades. If we see a point like this, price rallies up. If we get into a trade, we're mindful that the order flow is going to probably, there's a high probability we're going to see it stick here. So it'll stick here, might stick a bit here, but it'll typically stick here as well, which it does at this base right here. It sticks, and then it runs down close to the point of origin here. But these micro price relationships are very, very important to our trade, not only our trade selection, but also our position management. So we just had another run at the day's high. And while I think we can run through the day's high, what I would do at this point, we're at 96 now, I'd probably, the next interaction here would be, and again, we're not looking to be profitable, we're just watching price behavior. So let's just take it to where we are here and now at this specific time. Just I want to talk about a question here because it's an important question. The question is that scalping? My trading model is not a scalping model. So on the subject of scalping, because it's an important question to put things into context. What we are doing here is we are having frequent interactions with the market in order to arise at conclusive, consistent price behaviors. Now, while we can do that because we've got higher frequency interactions with the market, when I make my trade selection, I might only make 1 or 2 trades in a day, or one trade in a day. So I'm only selecting when it comes down to actually taking the trades that are in my model. I'm only taking very, very, very few trades, but they are very high probability trades in my opinion. Sometimes I might take more. Sometimes if I get into a rhythm, but it's for me it's not scalping. While the trading development process established by approaching it with frequent interactions, you can call it scalping, but it is a training exercise that you want to put yourself through. Now, I am not saying become a scalper at all, because I think if you're not making 1 trade a day, if you're not successful in trading 1 trade a day over a period of time, then you're not going to be successful taking 10 trades a day or 20 trades a day. You're just not. That's how the numbers work, because you're actually the probability in your trade selection is actually going to decline. The larger sample size you take, the more it dissolves the quality of trade selection. So with this approach, I mean, somebody might have trades otherwise, but that's philosophically, it's a fact. Okay, so the numbers. So the idea here is to identify consistent price behaviors where we find the high probability price behaviors, but everything that we've learned in the interim by engaging in a high rate of frequency, everything that we've learned in the process is going to contribute to the ultimate trade selection when it comes down to taking the live trades on a full risk profile. Okay, so Mike, I trade on all time frames, so the highest probability trades are the ones that are on the higher time frames. Call it 1 hour and up. But obviously the daily charts, the big numbers, the big levels on a daily chart, or big patterns on a daily chart, I'm gonna trade those. Um, uh, so just, and again, this is another very important point you raised, Mike. So while the trade selection is based on a level on a higher time frame, um, I'm watching the price behaviors because I know where my level is. I know the number, but I'm watching the price behaviors on the smaller time frame to ultimately place the trade. Okay, so it is the behaviors on the smaller time frame that are going to inspire my initial trade management, because these little micro behaviors that we see here on this 5-minute chart, these are really important to us, because as we come down, I call this the anatomy of a price swing, and it's very consistent and very natural. These price behaviors, as price draws back and then draws back up, we see consistent price interactions and order flow. So we use that information to manage our initial entry. So while this 3,800 number, I mean, we just took it today somewhat randomly, but while this 3,800 number may be a big number on a higher time frame, that's where my trade's going to be. I'm going to watch the small price behavior to make my entry and then manage the first element of the trade. Okay. So if we come back down, so if price goes up, so rather than just sitting in front of your chart and doing nothing, if you've created a plan, if price goes up, we have a plan. If price goes down, we have a plan. So we're sitting here watching the day's volatility, whether there's data events or not. And Yellen is, and Yellen has been on. If price drops, we're going to execute and interact. Again, we're interacting, not to seek profit. Okay, so but to seek an experience and interaction based on a structured framework, really critically important. Okay, so if it drops, we've got a plan. If it rises, we've got a plan. So we're constantly consumed by market behavior, and ultimately this goes deep into our subconscious over time. So it raises your level of proficiency very, very profoundly. Okay, and you'll actually be learning without really realizing how much you're learning until you really start to see it. It's really quite phenomenal. And in my opinion, I know everybody trades differently, but understanding price action, I think if you're a discretionary trader, I just really think it brings you, the reason why price action is because it brings you closest to the market psychology. Okay. Okay. So this is really effectively what we're looking at. So as price kind of ticks on here, we're just looking to interact with price, and it just further internalizes our feel for the market behavior. Now, the euro dollar has been pretty flat lately. So even when price is flat, you can still if you're just executing at the next level of support and executing at the next level of resistance, you're still getting some work in. Even though price is moving painfully slow, you can also do it. On the pound dollar, you can have two currency pairs running at a time, obviously, but it should be structured. You don't want to have any alternative distractions. You just want to be focused on your interactions with price. So if price drops, I would look at about. I actually think that this level right here, this one here is very, very secondary. But I'd be looking at or closer to this. I'd look at 37.80 because price is moving so slow. I'd look at a reaction around 37.80, 37.75. So what I would do is let's just say I would right here, if price gets right here, I would buy it and I'd place a stop below the 70 level or just below the low, below the 70 level. And I'd place a limit probably just below this 90 level, okay? Just because that's where that area of order flow is. And so we would get taken in, and either it's going to run down and stop you out, or it's going to rise and limit you out. But here's what I'm taking in at this time. I'm looking at exactly what time of day is it? How close are we to around the last hour of London closing? how close are we to the top of the hour, what events are coming out, what events have just passed. All of this information is being understood and considered. So here we just hit the day's high, and we're retracing. And if this sort of area of order flow breaks, then that's probably it. This day's high is probably in place. So which means that price could come deeper. Doesn't matter. The idea is that we're executing here. If we get stopped out or limited out, doesn't matter. We take the next level. So you're constantly interacting with the market under and considering the market conditions at the time. So then you take a screenshot of what has occurred, maybe after one or two interactions. You make notes on the interaction, make notes on the time of day, what data was there. So all of this process builds your trading persona. The goal that you want to achieve is you want trading to live inside of you. And the only way to do it is through a structured development process. Please, folks, it has to be done this way. If you're going out trying to copy what somebody else does, there's just too many voids. And in fact, it can be more destructive to your psyche as a trader than productive. Okay, so really, really important. Now, you can certainly go out and explore what other people do. How do they do it? How do they think? What tools are they using? Put their tools to a test. That's all, that's a part of the natural exploratory phase, I call it. If you've seen my trader development model. So I think that the marketplace has a lot to contribute to help traders to develop, but ultimately the point at which you're going to succeed in your trading is when you've gone through this process and you become an independent thinker. So before we conclude here, so your position observation protocol, let's say you apply a 10 and 10 or a 20 and 20, or that changes, or maybe you enter into the market and you actually engage in moving your stop based on specific price behaviors. For me, that's how my average gain-loss ratio had evolved. So FX Boyke, you can follow. There's always a lot to learn from experienced traders, absolutely, and it's a good idea to go in there, study what they do, get some ideas. Because what it will do is it will help to accelerate how you want to devise your development plan. And I want to make sure that I'm fully understood here, properly understood. I just want to make sure that we're clear on this, because often I can say things because I'm trying to pack a lot in a short period of time. Often what is said can be misunderstood because it's taken as a soundbite. But definitely so. For example, like I will show a whole range of price behaviors that we study and how to study them. And then what will happen is because you are of a completely different psychological profile, you will internalize the price behaviors slightly different than anyone else will, because it's uniquely your own. And then while you can take very similar trades to what we could take, your decision-making process will be contingent upon the level of internalization and uniqueness that you've applied to that trading protocol, or that trading that trade selection. Okay, so we're building massive sample sizes in order to find that one trade that we like, the second trade that we like, the third trade that we like, and we have trades that we don't have names for the trades, because there are price behaviors that are supporting a high probability trade selection at any given point. based on the consistencies that we've seen. A lot of our trades just come from how price evolves throughout the course of a day, and there may not be a name on it per se. Okay, so so the I think the if this webinar has been maybe too much information for you, it's a good idea to go over it again. There's a number of webinars at FXStreet that I have done that can give you different perspectives on price behaviors and on this as well. But repeat, just go through the webinar again. And we're here, and we're trying to help the trading community. And it really helps if you're not sarcastic and disrespectful. I've got a website with a lot of members, and they're always very, very respectful, and we really appreciate it if you're respectful to us. And I speak on behalf of the other presenters as well. You need to go about this business professionally, and go about it properly. And I really hope that you can appreciate us saying that. No, John, I wasn't picking on you. It's okay. It's okay. Yeah, I know it's tough because everybody comes from a different space. It can be difficult to go into a webinar and try to pick up everything the person is saying because it's often very new, and so it just what it does, it gives you a bit of a different view on the market. And then you can consider it in terms of whether or not it has a place in your trading or the direction that you like to take with your trading. So, for example, there's on this slide right here, for example, I go through these parameters, and everybody has a different way of looking at the market. So they'll place a different weight on. So some people are just very inclined to programming, and they like algos, or some like the mathematics, or people back test differently. And some like the psychology, and some people trade when the moon's a full moon and these kind of things. So, and there's virtually nothing wrong with any way that people trade, as long as you have engaged in the right process and developed soundly. So I hope that helps. Boyke, there's an ebook probably floating around the internet. It's called Face the Trader Within. It's a bit maybe dated, but it's more or less on just some basics on psychology. So you can have a look for that one. You'll probably find it around on the internet somewhere. There's one on the website as well. Okay, so I want to thank you all very much for your time. I appreciate it. I enjoy doing this, and I hope that you find value in the information. It encourages us to continue. Okay, so I appreciate it. And sorry there, John, I didn't mean to make you think that I was picking on you. All right.